The Federal Reserve has a lot to do at its meeting this week, but ultimately may not end up doing a whole lot in terms of changing the outlook for monetary policy. In addition to releasing its rate decision after the meeting wraps up Wednesday, the central bank will update its economic projections as well as its unofficial forecast for the direction of interest rates over the next several years. As expectations have swung sharply this year for where the Fed is headed, this week's two-day session of the Federal Open Market Committee will draw careful scrutiny for any clues about the direction of interest rates. Yet the general feeling is that policymakers will stick to their recent messaging, which has emphasized a patient, data-driven approach with no hurry to cut rates until there's greater visibility on inflation. They'll make it clear that they're obviously not ready to cut rates. They need a few more data points to feel confident that inflation is heading back to target, said Mark Zandi, chief economist at Moody's Analytics. I expect them to reaffirm 3 rate cuts this year, so that would suggest the first rate cut would be in June. Markets have had to adjust to the Fed's approach on the fly, scaling back both the timing and frequency of expected cuts this year. Earlier this year, traders in the Fed funds futures market were anticipating the rate-cutting campaign to kick off in March and continue until the FOMC had cut the equivalent of 6 or 7 times in increments of quarter percentage points. Now, the market has pushed out the timing until at least June, with only 3 cuts anticipated from the current target range of 5.25% minus 5.5% for the Fed's benchmark overnight borrowing rate. The swing in expectations will make how the central bank delivers its message this week all the more important. Here's a quick look at what to expect. Though the quarterly plot of individual members' expectations is pretty arcane, this meeting likely will be all about the dots. Specifically, investors will look at how the 19 FOMC members, both voters and non-voters, will indicate their expectations for rates through the end of the year and out to 2026 and beyond. When the matrix was last updated in December, the dots pointed to 3 cuts in 2024, 4 in 2025, 3 more in 2026, and then 2 more at some point to take the long-range federal funds rate down to around 2.5%, which the Fed considers neutral, neither promoting nor restricting growth. Doing the math, it would only take 2 FOMC members to get more hawkish to reduce the rate cuts this year to 2. That, however, is not the general expectation. It only takes 2 individual dots moving higher to raise the 2024 median. 3 dots are enough to push the long-run 25 BP higher, Citigroup economist Andrew Hollenhorst said in a client note.